What we're going to do now in economics is use Learning, Earning, and Investing, which is a program of lessons put out by the National Council of Economics. We're going to do a lesson today on mutual funds. I'm going to give you some handouts, some activities to do that. I'm going to have a couple of visuals up here on the screen as we go through it. You're right now in groups, mutual fund groups. We've been doing stock market, and we've learned quite a bit about the stock market. Okay, what's the value of buying a stock, Billy?
Well, if the company starts doing really well, the value of your share goes up.
Okay, and you get what from that?
You get more money.
You get more money. You make money. The idea here is to make money. Mutual funds are a little bit different way of buying stocks, and they're buying stock in group. I'm going to give you a couple of handouts, and you'll be buying as a group. So you've all bought into this mutual fund group, and you'll be making decisions in a shared way. When I did this lesson a year or so ago, that was the one thing that students at the beginning got a little confused. They were thinking that what Robbie and Billy were describing, that they were making their own decisions. You're making a shared decision. So when we talk about a mutual fund group, as I said, you're buying in. And the money that you're bought in was, you bought at $10 a share. So you have $3,000 to invest. So $10 a share, $3,000 to invest. How many shares? 300. Thank you, Billy. Some difficult math there. So you have 300 shares at $10 a share, so you have a pool of money, $3,000. So you all make money together, or you all lose money together. And that's the idea behind a mutual fund. And people buy mutual funds every day. At the very end, we're just going to talk about hedge funds. So as I said, I've given out activity 1. If you would, so everybody has $3,000 to invest. You can turn over your sheets now. And what you have here are a number of stocks. You have American Cellular selling at $5 a share, big box stores like Walmart. We've studied that before. We saw that frontline video on it, but that's just one of the big box stores, $20 a share. A biotech industry in terms of making different legal drugs, pharmaceutical company. General Grocery, Giant Auto, $10 a share, Gold Mining Group, $5 a share. And what you're going to do right now is you're going to buy some of these stocks. You can put money in all 6, or you can choose to buy only 3. But you have to spend your $3,000 on at least 3 of these 6 stocks. One thing a mutual fund has is a fund manager. So I would say right now, when you're going to make your decisions, elect a fund manager just to coordinate in terms of writing down the numbers and doing some of the math. So when I stop talking just a second, you're going to decide to spend $3,000 on at least 3 of these 6 stocks. You can spend your money on all 6 if you want. And someone will be doing the math, your fund manager, and you will just see how you do when we go to activity 2. Okay. Okay, I think that everyone is done in terms of figuring out their stocks. Just want to, their funds. I know Brad was a fund manager over here. Who was a fund manager here? Chris was. And who was a fund manager here? Allison. And who was the fund manager? Billy. Okay, so we have our fund managers. Okay, normally with the fund manager, it's not elected. Normally what happens is you go to someone that's running a fund and give them money, or a group of people give them money in order to invest. What we're going to do now, what I'm going to do now is give you out activity 2. And activity 2 is 1 year later. What I'd like you to do now is the math. How did you do on your investments? For instance, you see that American Cellular is now selling at $8 a share. You see that gold was $5, it's gone down to $4. Billy, in the real world, what's gold doing now?
Skyrocketing.
It's skyrocketing, right. Here it's gone down a little bit. So this is certainly not completely real world, but in terms of what we're doing in this lesson, this is what's happened. So your fund manager should do the math on this. For those of you that are done or still working, The visual up here I have is 1 year later, what it should look like. Obviously, your numbers are going to be different in terms of what you invested. But in terms of the price per share as it's gone up or down on these different stocks, the number of shares that you bought, this is just an example, the amount that you invested, and then, of course, the 1 year later. In this example, it's gone up. They've made $450. The price per share then goes up. Remember, we said originally $3,000, 300 shares, $10 per share, depending on how many shares you bought. 300, so the price per share went up because the value went up. So this is what your completed sheet should look like. Obviously, the numbers will be different. Let's start over here actually with Brad's group, fund manager. And how did you guys do?
Lost $595.
Okay, what were the things that you invested in that lost money?
We put almost all of it in biotech.
In biotech. And why did you make that decision?
Because I think it's going to go up in the future.
Okay, in the
Yeah,
future.
of course.
And pharmaceuticals have done very well. Absolutely. And that's, what were the other stocks you bought?
We only bought one other share of American Cellular.
But did you buy 3 stocks in total? Or?
Yes, oh yeah, we bought one of Gold Mines also.
Okay, so you put almost all your money in the biotech.
Yeah.
And that was a mutual decision? Was anyone against that decision?
Mutual.
Okay, okay. And our last group, Billy's group here is fund manager?
We made 800.
Okay.
We had like half of our stuff in American Cellular,
Okay.
and then we had some in biotech and gold, so that those didn't do too well. But American Cellular.
How many shares did you buy in American
We had
Cellular?
350.
Okay, so you put quite a bit of money in there.
Yeah.
Okay, and it did well for you. And how about the decision-making process?
It was pretty good.
Yeah.
Was, okay. Good, so you're happy with Billy?
Yeah.
So Billy's group,
I think so.
you know, I don't know if you want to say wins, but in terms of making money. But obviously, what goes into the decision-making process, and the reason so many of you invested in the biotech is that you guys actually have been following the stock market. You're very aware of what's gone on in that industry, and you know that normally that would be a good investment. What we're going to do now is we're going to talk a little bit about some of the definitions of mutual funds and what goes into a mutual fund. I'm going to give you out another sheet, another activity. And this is an activity in terms of looking at some definitions and then answering questions. And let's just take a look. Some of this we've already done in terms of understanding some of the basics of the mutual funds. But let's just read some parts of the first page here. I think you understand that mutual fund is a pool of money. I think you understand that. And your shares went up, as we showed you before. Depending on making money or losing money, your shares could go down. So you make money as a group and you lose money as a group. Investors may buy shares of an open-end mutual fund each business day for the net asset value, the investment value of each share. Moving down to the next paragraph, there are about 6,000 mutual funds in early of 2003. I'm sure there's definitely a lot more than that now. More Americans invest in mutual funds than any other investment method. There are stock mutual funds, bond mutual funds, a combination of both, stock and bond, and then also money market funds. Mutual funds that specialize in any type of stock or bond. So you may get mutual funds that are only in pharmaceuticals, mutual funds that are only in technology, depending on which ones you think will do well.
Sector fund then?
Yes, exactly. Would be just a certain area. I think Billy has a future in mutual funds over here. And then some funds buy high-risk investments and some buy low-risk. So there are different types of stocks in terms of, mutual funds in terms of high-risk or low-risk, depending on what kind of investment that you want. You look for performance, as we go to number 1 here. Buy mutual funds that will perform, you believe will perform well. A mutual fund prospective lists of stocks or bonds a fund owns and provides information on the fund's performance. The fund manager is a key to performance. It is a good thing that the fund manager has had favorable results. So you want to look at how fund managers have done before this. This takes a little bit of legwork. It takes a little bit of research. And when it's your own money, people tend to do a little bit more research, hopefully. And then in terms of cost, some funds charge what's called a load. As it says here, load is a sales commission. So with Chris's group over here, he was the fund manager, and you hired him to be your fund manager. He would get a commission from you depending on how much money you were making.
You said it depends on how much you make. If you're selling and buying at the same time, does she get a commission based on like the net or?
She gets a commission anytime I ask her to sell, whether it's a gain.
It's not.
It's like a
Right.
flat rate.
It's a flat rate. With the mutual fund, it's a little bit different, but generally the fund manager is making money.
Okay.
Unless everything just tanks and then he's heading for the hills and you're all looking for him. But generally, they charge a load, as we said. A load is a different kind of word than you may be used to. You may just be used to a commission. Kelly?
Is there a capital gains tax when you sell?
That's a very good question. There is. And that's something that the fund manager would be looking out for in terms of, you know, are we making money? Are we losing in terms of paying a capital gains? Capital gains has to do with how much money you make on your investments. Know that whenever you invest with someone, they're not doing it just out of the good of their own heart or because they like you. They're doing it because they want to make money too. And then finally, convenience. A fund that provides good service is very helpful to the investors. And then it gives you a couple of questions there. Some fund families have dozens of different funds for different investment objectives. If you turn over to page 2. And we have questions for discussion. And what I'd like to do is just take a look at a couple of them and see if you actually, why don't you take a couple of minutes and divide the questions up in your group, and I'll give you about, say, 5 minutes to try and answer this page. Okay, let's go through a couple of these answers that you have here. Again, some of them you may be not able to answer completely, but I'll fill in the blanks for you. And we'll go through about, we'll see how many we can get through. Let's start out with the Baker's group over here. Okay, first question. Who did What is a Mutual Fund? Billy, you did that one?
I guess I did.
Okay.
It's a fund that includes like a lot of different stocks, and you can invest in it.
Stocks and bonds. Good. Let's go over to this group. Who did question B? Okay, Kim. A friend tells you all mutual funds are the same. How do you reply to your friend?
I would reply, there are many different types of mutual funds. For example, some of which are specific to a particular area, like pharmaceuticals.
Absolutely. So your friend is wrong. And what should you consider when deciding which mutual fund to buy?
I said that you should consider if it's going to be like a long-term or short-term investment. If it's a long-term, you probably want a low risk. If it's short-term, a high risk.
Okay, what might be one other thing besides high and low risk? I mean, you're kind of on the edge of it with
maybe the history of the fund manager and how much money he usually makes.
Right? And cost and convenience. And right, and its performance. So you kind of said performance, but just to put that word in there. F is Kim again. Kim, the question is, more Americans own mutual funds than individual stocks and bonds. Why do you think this is so?
Because they have more, I guess, flexibility, and like some mutual funds, like index funds, can be used to reach a specific index by investors.
Also, Kim, think about what we did as a group here before. You bought in a certain share. Kelly just mentioned low risk or high risk. What's the risk in terms of being together with a group?
Low.
It's lower because the risk is spread around. If you want to buy a mutual fund, if you want to buy a mutual fund so you will have money to buy a house 10 years from now, what type would you buy?
Well, I said a low risk mutual fund in order to achieve long-term stability.
Okay. Let me just think. My stock market person asked me that a number of years ago. I ended up staying in Manhattan with an apartment, but you're right. What is your goal here? Do you want to buy a house in 10 years? Are you saving for college for your children? Are you saving for retirement? Our last activity, a mutual fund prospectus, in terms of looking at in terms of looking at what could be an investment. So let's take a look at activity 4. All mutual funds supply potential investors with a prospectus, how they're performing. It provides information including investment objectives, strategy, performance, costs, and other charges. The fund is an aggressive stock fund seeking long-term capital, and this particular one that we have here. The fund is 100% no load. There are no 12B-1 fees that we mentioned briefly before. It's investing in smaller companies. The fund's annual management fee and other expenses are 0.91%, so less than 1%. These expenses are deducted from the fund's assets, and then the table below summarizes the fund's average annual returns. And just taking a look at this, digest this for about a minute. Look at this prospectus that I've given you. Take a look at 1, 5, and 10 years, just for a minute or so here. What is it telling you? Courtney?
Well, but it's long term because it improves over time. Like the first year you wouldn't think it was you're getting negative returns, but by the end it's a lot higher.
Absolutely. So this is a long-term investors. Remember we said, I think Robbie was answering that question before, are you saving for a home over, say, a 10-year period? Do you think this would be a good investment for something like that?
Yeah.
Yeah. This is a long-term investment. Just to read a couple of the numbers, in 1 year, in just about every category except for one, it's in the negative. As we move to 5 years, every category is in the positive, and then 13 years, every category, just double check, every category has gone up and really, in a way, doubled in one way or another. So that would be very important in terms of, as you're getting, say, to be 35 years old, 30 years old, in that area, as you get a little bit older, someday you'll be in that age bracket, this would be a good type of mutual fund over that period of time. In terms of types of mutual funds, we've talked about it before, but just to show you a visual of it, the high risk, and the high risk on the right, the low risk over here, in terms of money markets tend to be low risk. The bond funds, those would be more the low risk. Then in terms of the growth, I mean the high risk, it's anything that you see the word aggressive. Our last thing I wanted to bring up was hedge funds, and this is just a definition I got online in terms of the difference. As I says here, it's 200,000. I thought it was 250. 200,000 invest income for 3 years in a row, and at least $1 million in liquid assets. What's a liquid asset?
You can turn it into cash very easily.
Okay, right. And certainly you have money that's tied up. When we talked about near money and distant money in terms of M1 and M2 and M3, we saw that certain money you can get more quickly. Hedge funds employ a wide variety of trading strategies, invest in exotic derivatives, swaps, forwards. Forwards are that I'm going to buy things that I think are going to make money over the next 30 days or 60 days. So hedge funds are riskier, a bigger investment, and in terms of control, the control is not as great. So did you guys learn something about mutual funds today? Yeah. Okay. Enjoy the lesson?